Alright, so in the last class, I talked about market structure, and so in this class, we'll be going more advanced. Now, when you're looking at market structure is where we seek to interpret how trends move, the structure with which trends progress towards whatever direction that the market wants to move in, right? But in the study of market structure and the study of trends, it only becomes applicable when you understand order flow. Now, what is order flow or institutional order flow? Order flow is simply how markets move from buys to sells in any direction. The progression that the market moves, that the market makes while moving in a trend, while buying and selling. That movement, that transition from buys to sell to buy to sell to buy to sell is what we refer to as order flow or the flow of orders. Now, order flow is also the blueprint that price leaves behind while it is progressing towards a certain direction. And so, order flow becomes a more applicable way to look at market structure in order to help us actually read the trends and apply what we know to actually get trades. Now, I'll start from trends as we know it, market structure as we know it. Now, we've already established that the market structure of an uptrend is higher highs and higher lows, right? Higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? And then the market structure of a downtrend is lower highs, lower lows, lower highs, lower lows, lower highs, and lower lows. Now, in every trend, there are two parts. There are two parts apart from we are not talking about the highs and the lows in trends. So you already know that the bottoms are lows and the tops are highs. In every trend, there are two parts in the trend, whether it's an uptrend or a downtrend. We have the part called the impulse. We have the impulse, and then we have the retracements or pullback. In every trend we have impulse and then retracement or pullback. You might know it as retracement, you might know it as pullback. These are the parts we have in every trend. Now, what is the impulse? The impulse part of every trend are the parts of the trend that move in the same direction as the trend. Meaning that if the market is an uptrend, the impulse part of an uptrend are the parts that are the parts that move up. Meaning that in this uptrend, these lows, every move from a low to a high to a high is an impulse move, because that's the part of the trend that is taking price in the direction that the trend predominantly wants to head in, which is up, right? So every higher low to higher high is an impulse move. And as a trader, we focus on trading the impulse moves. We focus on taking the buys. So we are our your tag in a market that is trending up. Your target or your goal is to catch a higher low and ride it till it creates a higher high. That is your goal, right? Your goal is to trade the impulse moves, because when you are trading the impulse move, you are trading with the trend. And when you trade with the trend is your friend. That's where the money is, right? And then the retracements are the parts of the trend that move. The retracement or pullbacks are the parts that move in the opposite direction of the trend for a brief period of time, like a period of rest in that trend, to allow buyers settle on a new place where they want to buy from, settle on a new level where they want to buy from, to start a new impulse move. And so the retracements are the parts that move in the opposite direction of the trend. And so in this market here, in this trend, the parts, the sells, the higher lows, the higher highs to higher lows are the retracements, the pullbacks, right? So the parts that sell, the sells in an uptrend are the retracements, they are the pullbacks, right? And basically, in any trend, you don't want to focus on trading the retracement, because retracements are shorter than impulse if most times, if your trading strategy is to try to always catch retracements, you make a lot more losses than profits, because retracements are unreliable, you cannot trust them. And it's the same thing in a downtrend. In a downtrend, the impulse parts of a downtrend are the sells to buys. So the lower highs to lower lows are the impulse parts, and those are the parts you want to trade in a market that is downtrending, in a market that is selling. Those are the parts you want to trade. So these are the impulse moves. Every sell in a downtrend are the impulse moves. Every sell, every lower high to lower low, right? So in a downtrend, in a market that is selling, your goal is to catch price while it is making a lower high and ride it till it creates a lower low. Right, that's what your trade setup should look like, right? And then the retracements are the parts that buy, right, the brief pullbacks in the opposite direction of that trend, which will be up, right? So those are the pullbacks, those are the retracements. It's actually very simple stuff. It's a very simple concept, easy to grasp, and I believe that you've grasped it. You've grasped it already. So these are the retracements or the pullbacks in the downtrend right here. These are the pullbacks, right? So simple. That's it. These are simply the parts of a trend, right? Now, let's scatter, let's dissociate or reduce each individual part of this trend. We should reduce it and take it apart. The structure, because as a trader, what we trade is swings. We trade swings. Every low, whenever a market moves from low to high or high to low, it's called a swing move, right? If that means what that means is that impulse moves are swing moves. Retracements also are swing moves. But as a trader, we only focus on one type of swing move, which is the impulse swing move, because that's the surest and most certain move that can pay us money when we trade. That's where the power is. That's where the strength and momentum in the market is, in the impulse move, right? But basically, every move is a swing move. That's why you hear concepts like swing high, swing low, right? That's what we mean. So this low is a swing low because it's a low that took price from bottom. As soon as price got to this low, it kind of swung, right? There was a swing and then a reversal in direction, right? So that's what we mean by swings, swing highs, swing lows, right? Areas where lows and highs where price swung direction, dramatically changed direction, right? Now, in an uptrend, you are trading the bullish swing structures. You are trying to catch bullish swings, meaning that you are trying to catch higher lows and ride it to the creation of a higher high. In a downtrend, you trade bearish swings, meaning you are trying to catch a lower high and ride it to the market creates a lower low. Now, these structures, these bullish swing structures and bearish swing structures are what is referred to as order flow legs. They are referred to as order flow legs because you already know that the movement of price from high to low, buy to sell, is what is referred to as order flow. Now, the structures, the bullish swing structures and bearish swing structures are referred to as order flow legs. They are called legs. That's how we usually refer to structures in price. We refer to them as legs. So they are called order flow legs, right? Now, they are valid order flow structures. If you want to be able to tell proficiently the direction of price accurately, majority of the time, you want to understand order flow. You want to trade order flow, right? Order flow is simply market structure, but when you are studying order flow, you are learning advanced market structure. Now, there are order flow legs that are valid, and there are order flow legs that are invalid. We have valid order flow legs and invalid order flow legs. So there are order flow legs you trade, and there are order flow legs you will not trade, right? It's important to note. Or we have valid order flow legs, invalid order flow legs. Now, what is a valid order flow leg? A valid order flow leg is an order flow leg that is made up of three things. Now, what are these three things? Every valid order flow leg is made up of three things, and one of these things is the most important and actually what determines if it's valid or not. Now, the first thing that every order flow leg is made up of, or every swing structure is made up of, is a swing point. Now, this swing point can be a swing high or swing low. Now, the second thing that every valid order flow leg is made up of is something called a fair value area. Now, what is a fair value area? A fair value area is simply the retracement area, a point where retracement has happened already, right? Fair value area or retracement area. It is in your fair value area you find points of interest to trade a new swing structure, to trade a new impulse move, right? So every order flow leg will always have a fair value area. These are things that price will always create as long as it's creating an order flow leg, as long as the market is trending, making higher highs or higher lows, or lower highs or lower lows, right? Then the third thing, which is the most important thing that you have to watch out for, that to determine if an order flow leg is valid or not, is something called a fair value gap. This is very important. An FVG, a fair value gap. These are the three things that a valid order flow leg is made up of. Then how then do you know an invalid order flow leg? An invalid order flow leg, we have the first thing, which is a swing point. Every order flow leg will have a swing point. It will also have a fair value area. But the determining factor that determines whether an order flow leg is valid or not is the appearance of a fair value gap in that structure, in that order flow leg. Price cannot make any swing structure without having a swing point, a swing high or a swing low, or a fair value area, which is the retracement area. But price can create an order flow leg without leaving behind a fair value gap. Now, what's the reason for it? It is because fair value gaps actually indicate momentum. Fair value gaps show you or tell you that there is momentum, there is buying strength in this impulse move, in this swing move, there is selling strength in this swing move, right? And we trade momentum. Right? As a trader, we don't cause the markets to move, we don't make price move. Price moves because there are buyers and sellers moving price with large money, hedge funds, big banks, right? And what our job is to pay attention and to find what party has the most strength in this market, the buyers or the sellers, and then join that party, right? And so if the buyers are the ones with strength in this market, we join them. If the sellers are the ones with strength in this market, we join them, right? And so how do you know if buyers and sellers have strength? Because price could be moving in a direction, price could be buying in an uptrend or selling in a downtrend, making a bullish impulse move or a bearish impulse move without the creation of fair value gaps in that move. That tells you that the strength of the buyers or sellers in that market is waning, it's reducing, right? The opposing party is struggling strength with them, or they are closing out their orders, they are exiting the market, and so you will want to be wary of taking trend continuations of that trend until price creates a valid order flow leg with a fair value gap, right? And this is why order flow is so important. Order flow doesn't only allow us to know if a trend has momentum. Order flow also allows us to know the direction that price is moving in, because if price is trending in a certain direction, it will create fair value gaps in that direction. If price has intention of buying, it must of a certainty create fair value gaps in that direction. It must either create a bullish fair value gap or a bearish fair value gap. So these are things that you have to note, right? I will show you what a fair value gap is for those of you who do not know what a fair value gap is, right? So this is what an order flow leg looks like, right? Now this is the basic structure of every trend, every uptrend, right? You have a retracement that takes price into a point of interest, a PDRA. It could be a fair value gap, an order block, mitigation block, breaker block, support or resistance, whatever it is. A retracement that takes price into that PDRA, and then the creation of a swing low, right? So swing points, we have starts with the fair value area, right? Fair value area that takes price into a point of interest. Within that point of interest, we have the creation of a swing point. In the case of an uptrend of a buying market, it's a swing low, right? Price creates a swing low, and then from that swing low, we have the impulse move beginning. The impulse move starts, right? The impulse move starts and takes price higher to create a new higher high, right? That higher high when the impulse move is exhausted and price has finally created a higher high it wants to create, we have the creation of a swing low, of a swing high that causes a new retracement, right? Causes a new retracement. Basically the repetition of this structure again. A retracement that takes price into a new PDRA, and then the creation of a swing low, and then an impulse move out of that PDRA, creating a new higher high. And just like that, we have this structure repeating itself over and over and over again. The same thing in the downtrend. We have a retracement that takes price into a point of interest, a PDRA, creates a swing high, and then the start of an impulse move that creates a lower low, and then the creation of a low of a swing low, another retracement again, creation of another retracement, and that retracement takes price again into another PDRA, any kind of point of interest, and then creation of a new swing high to give us an impulse move, right? And then now, if you notice, each of these scenarios I've given, right, I've not talked about the fair value gap. Now, where is the fair value gap? Where are you expected to see the fair value gap? Where are you watching to see fair value gaps? Now, fair value gaps that indicates whether a trend has strength or not, or whether a market is going to continue in a certain direction or not, are always found in the impulse move. It is expected that if a point of interest, if a PDRA is going to hold a support or resistance, a trend line, an order block, a fair value gap, if it is going to hold, it is expected that that PDRA, that point of interest, creates fair value gaps coming out of it. So it's expected that the impulse move that is being created from that PDRA to show us that the buyers in the market existed within that point of interest, and they entered the market from that point of interest. We should see price creating fair value gaps, because the reason why price leaves a gap in the form of a fair value gap in the first place is because price moved so fast due to momentum, due to the large number of orders that the buyers were placing from that position that price is coming out from. And so if there's no fair value gap created, it means there is no momentum, there's no large number of traders at that point, and so you want to stay away from such an impulse move. Understood? And so we expect to see a fair value gap created. A fair value gap should be created before price breaks out of the previous higher high that the market made. This is where the previous higher high that the market would have made would be, right? We expect a fair value gap to be created, and is that fair value gap should be created before price breaks out of this. It is that fair value gap that will be the impulsive move that will help price to break out of the resistance at this previous higher high and create a new higher high, right? And when we see such a fair value gap, when we see such a structure created, let me write in here fair value gap, FVG. When we see such a fair value gap created, okay, okay. When we see such a fair value gap created, before price breaks structure, that first of all validates this new order flow leg, because at that point now we now have a valid order flow leg that we can now take a new trade from. Because if let's say we wrote this first move and then we've closed our entry, and this market has given us a fair value gap indicating that the trend is still likely going to continue, right? But if before a trend continues, a trend will not just keep buying forever. It will give a retracement. It must have a period of retracing back retracing back and then starting a new impulse move, right? Because that's how the market moves when it's making market structure, when it's trending, right? So now that we've seen the fair value gap, this fair value gap now serves as our new point of interest, serves as a kind of marker to let us know that this is around where you should be watching to take a new buy from this area to ride a new impulse move, right? And then where would our target be? I will talk about targets in a bit, right? Because when taking trades, you must have targets, you must have an exit target, right? Targeting this previous higher high, right? So if we enter a trade from at this point, we are exiting at this point, because this is where liquidity is, this is where the target is, right? And that's where we want to exit the market and exit the trade. And so this is order flow basically playing out. This is what order flow actually is and what order flow actually looks like. So these are the three essential things that an order flow leg is made of: a fair value area, a retracement area, a swing point, and then a fair value gap. The fair value gap serves as the point of interest that we trade, and also as an indication of whether that order flow leg has strength, is valid, or is something that can be traded off of, right? So this here, right here, over here, I tried to to give a depiction of what an order flow leg will look on candlesticks, right? So you see this is an uptrend, right? This is basically this structure we are seeing here in line. I try to make it out in candles, right? So what we have here, first of all, we have retracement, right? Red candlesticks retracing, and then we have price digging into the point of interest. And what you usually see is a swing low created. Now, how do you know how is a swing low created? A swing low is usually created, usually created, usually signified by a wick. You know, a swing low by a wick, right? The lowest wick that price creates before it swings around and starts moving in the opposite direction is a swing low. You can see that it's in between these two candlesticks, right over here. You can see it's in between these two candlesticks, 1, 2, 3, and it is the lowest with the lowest wick, right? And so this is the swing low, and you see price starts making the impulse move out of this range, this previous retracement range, and it is buying up, right? So basically, you want to take your buy at around this low, and then ride it till your whatever it is your target is, right? And then exit your trade, take your profits, right? If the trade moves in your direction. Now let's say, now where is the fair value gap in this structure? Where is the fair value gap? Now the fair value gap, first of all, people usually have issues with picking the right fair value gap to trade with. First of all, because most times in an impulse leg, price can create multiple fair value gaps. For instance, now we have one fair value gap right here. We have one fair value gap here, right? A fair value gap is the space between three candlesticks coming immediately after each other. So we have three candlesticks here. The candlesticks are usually named by their numbers, right? We have candle 1, candle 2, candle 3. So this is candle 1, candle 2, and candle 3. I think I will have to indicate that for you, or maybe no need, right? And in a fair value gap, the gap will always be on candle 2, which is the middle candle, right? This is candle 1, candle 2, candle 3. We are counting from where the swing low, from the creation of the swing low, from where price starts swinging up, right? So candle 1, candle 2, candle 3. Is there a space on candle 2? For a fair value gap to be valid, there has to be a space behind candle 2 that candle 1 has not covered. If you see the wick of candle 1, in this case here, the wick of candle 1 did not cover, candle 1 and its wick did not cover the entirety of candle 2 behind it, right? If the wick had covered the entire part, or the body of the candle had covered the entire part, it would not be possible to have a fair value gap here anymore. For a fair value gap to exist, there has to be space, an untouched space behind candle 2 and in front of candle 2 also. Meaning that what that means is that candle 1 should not cover the entirety of the back of candle 2, and candle 3, the third candlestick in the pattern, should not cover the entirety of the front of candle 2 also. Now, what space do we have left on candle 2? We have from where the wick of candle 1 stopped to where candle 3 started from. And so let's assume this is the wick of candle 3. Does it leave a space? Yes, it does. And so what this means for us is that we have a fair value gap at this point here, right? So this is a fair value gap right here. And what this fair value gap, no matter how small or big the fair value gap is, as long as it exists, it's an indication of momentum in that market. But usually, the bigger the fair value gap, the bigger the strength and momentum of participants in that trend, right? And so this is a fair value gap, right? And then we also have a second fair value gap right here. This is a second fair value gap that we have right here, right? So, and we also have a third fair value gap right here. You have markets where in the impulse move you have up to 4 or 5 fair value gaps created. So which is the valid fair value gap that you will use? Now, I'll have a separate video where I talk about points of interest in order flow legs and how to use them, how to know, because there are different types of fair value gaps. There are about 2 different types of fair value gaps, and they let you know what kinds of point of interest to use, whether to use an order block, a mitigation block, a breakout block, or to just trade directly from the fair value gap. I'll teach you all that in the next video after we've established this facts, right? But basically, the rule here is that you are expected to use the first fair value gap that price creates. The first fair value gap price creates is always the valid fair value gap, not the second, not the third, not the fourth, the first fair value gap that price creates, the fair value gap that helps price to break out of the retracement range, is the most valid fair value gap. Meaning that in this case here, in the case of this, where we have this fair value gap right here, this fair value gap is the most valid fair value gap in this market, in this impulse move. This fair value gap right here, we have the retracement, the swing high, and then we have the expansion of price down, the impulse move down, right? And so we take this as our fair value gap. And so if we are looking for an area where price should retrace back to for us to take a new sell, this fair value gap right here is the most valid logical region that we should wait for price to get to attempt to take a new sell from that region, right? And so this is basically it about order flow legs. This is what order flow legs look theoretically. Now let's go over to the charts. This is gold. I think I will use gold and one other market to try to show you these things, right? So let's take a look at this. So I'll start from the daily time frame. Show you, because when analyzing trends in the market, in any market, you start from the higher time frames. Now take a look at this. Price is trending, right? And we've established that whenever price trends, it creates order flow legs whenever it moves, right? This is higher high, higher low, higher high, higher low, higher high, right? Now take a look at this. Let's observe the structure. Are they order flow legs? Does it have a retracement area or a fair value area, a swing low, a swing point, and then a fair value gap? Yes, it does. If we even start from here, from this point here, this is where the buy started from. So we have low to create this high. This is an order flow leg. Now, mind you, this is the daily time frame, right? So this single candlestick here is multiple candlesticks on the lower time frames, and so we have this retracement to come into this area right here, and then we have price creating a swing low, and then the start of an impulse move out of it. Now, does this structure not look familiar? The structure I drew there up there previously with a line, you can see it's retracement, swing point, expansion, right? And so on the expansion, on the impulse, does price leave behind the fair value gap? Yes, price leaves behind two fair value gaps. This fair value gap here, and then this fair value gap here. Now you might be wondering why price did not retrace into the first fair value gap, and why price retraced into this and bought out of it. If we come up to the weekly time frame, you get to discover that on the higher time frame, this fair value gap does not even exist. All you will see is a single candlestick ending, and then price, a new weekly candlestick starting up, right? But after this structure is valid, this impulse move that happened from here is valid. It's a valid one, because we can see that after price retraced in here and then created a new order flow leg, we have the retracements, the swing low created, and then an expansion out of it that price made. All right. Now on the expansion candle, on the expansion side of the order flow leg, do we have a fair value gap? Yes, we have this fair value gap right here that price created. Now this is a specific kind of fair value gap called a breakaway gap. There are two types of fair value gaps that you have to take note of. Now for breakaway gaps, I'll have a separate video where I explain that, but just to give you a brief of it, a breakaway gap is a gap. When you see a breakaway gap, you don't trade directly from the gap, because in breakaway gaps, the gaps usually don't hold. The gaps are usually where liquidity traps are formed, inducements are formed. For breakaway gaps, when you have a breakaway gap in an impulse move or in an expansion move, what you want to trade, the point of interest you want to use, you want to look for a mitigation block, a breaker block, or an order block that overlaps or coincides with that breakaway gap that is on that order flow leg structure. And so that's why you see in this case here, price comes to the order block here, to this order block before it buys out. But if you are taking a trade on this in this market at this point in time, while targeting, now because we are taking this trade directly from the daily time frame, the risk reward is going to be low if you want to target objectively, because if you are targeting objectively, you are expected to target the previous higher high, right? So this is just a 1:2.27. But I also have a separate video where I teach you confirmation, how to trade from points of interest. When we start, after the video on points of interest on the different PD arrays that we have, right? Because basically you don't want to take this buy from the daily time frame. You want to come 2 time frames lower to the 1 hour time frame to find structures that price creates on the after coming into this higher time frame point of interest that will indicate to you that you can take a trade. For instance, let me try to take price back to this point. Let me see if, okay, I think I should be able to see the candlesticks. So when price got in here, let's see what structures it created. So I'll come down to the 1 hour time frame. Hopefully I can see that far. Okay, we can see that far. So this price digging into the speed array, right? So if we let me reduce this speed and let's play it out and see if price, because what we want to see, okay, first of all, what we want to see is price creating, because we are looking to buy from this point of interest. And so what we want to see is see price creating on this 1 hour time frame, on this lower time frame, see what price creating higher highs and higher lows, order flow structures. Order flow, it's not just about seeing price creating higher highs and higher lows. The higher lows to higher highs, the impulse moves must be valid order flow legs, meaning that they must have a fair value gap. So we want to see price create a valid order flow leg out of this higher time frame point of interest that we will now take our entry from, targeting either we are targeting this daily high, right? This is how we get higher risk to reward trades. Remember when we took the trade directly from the daily, we only got a 1:2. But if we take this trade now, this same trade from the 1 hour time frame, targeting this same daily target, we can get up to a 1:15, 1:7, 1:5, 1:4, depending on how large your stop loss is, right? So let's see, does price create any valid order flow leg structure? This looks like a valid order flow leg structure, but this is the first move, the first rejection that price creates, because we can see this is retracement, this is a swing low, this is expansion, right? And we have a fair value gap created on it right here. Price created a fair value gap, but we can see that price came into it again to test it, and it held for a while, but it did not break out of this high. And we see price, and it did not create a fair value gap also. Whenever price digs into any point of interest, we want to see it create fair value gaps when it's coming out of that point of interest. That shows us that point of interest is strong and is holding. So let's keep playing price and see what price does. So let's see what price does. So I think this spike have been a result of news. So let's see, let's keep watching, let's observe. I want to see trending structures coming out of it. So okay, that means I'll stop price here. Let me take it back. If you've been following me, or if you understand what I'm saying, since you understand why I want to stop this, because now what price has done now is create a structure for us, a valid order flow leg right here. Because what we have here, first of all, we have this retracement, because this is a retracement. Price retraced into this point of interest, created a swing low, and then created this block out, this expansion move out of it, right? And this is a breakaway gap. And so in breakaway gaps, like I said, you want to trade from other blocks or mitigation blocks. Normally here, my entry will be from the wick of this retracement candle, this candlestick that retraced from the wick here. But because it's a doji candlestick, this is a doji, right? It's the wicks are just too long, very small body. I want to come to the 30 minutes time frame and see if it will look like, if I will see a proper block. Okay, on 30 minutes time frame, I can see one bullish candlestick coming up, then bearish candlestick going down. So I will take my trade entry, either if I don't take from this week, which is most likely point, I will take it, my trading style, I'll take from the week. And when I start explaining point of interest, you understand why sometimes you will use the week. Because this is a mitigation, a breaker block actually. You use the week of mitigation and breaker blocks, and sometimes how to know when to use the body. So let's see if we want to have a smaller stop loss, we would use the body. Let's see if price gets as far as the body, or price just gets to the wick and buys out. So where are we targeting? You must always have a target in your trade, right? Objectively, objectively, normally, because we are playing this back in hindsight, we already know that price got to this daily target. But normally, if we're just in if we're in the market at the time, we want to target eyes that are closer to us. Maybe this eye first, then any other eye. So let's say stop loss just below. For breakaway gaps, usually whenever price gives me breakaway gaps, my stop loss is really very tight, because when price creates breakaway gaps, it does not go so far into the point of interest, right? So you could target this, or okay, let's say we just target this higher time frame, region level here. Right, so this is 1:5.14. Right, so let's play price. Let's play it out and see. Does price get as far as the body, or just gets to the week? Okay, price gets to the body, and let's see if the price starts buying out from it. Now I will show you how I usually get first, second entries using the same process. So let's observe and see. So now price retraced that. Now I'll stop price here. This is where I'll pause price. Now this is where I will get a second entry from this, because now we've seen price retrace, give us a new order flow leg, retraced, created a swing low, and expanded out, right? And it left behind this fair value gap right here. This is a fair value gap right here. This is a fair value gap right here. And so this is also a breakaway gap. And for breakaway gaps, we trade blocks. We don't trade direct from the gap. We trade blocks that overlap with the gap. We have this other block right here overlapping with the breakaway gap. I'll teach you how to pick out your point of interest out accurately, right? And so if I was to place a second entry in this market take a second entry buy from this would be its stop loss right here, same target as before. Okay, this is a 1:5.73. Overall, this is almost a 1:11 or 1:12, right? So let's play it again and see, does price trigger us in? Okay, price doesn't trigger us in before moving upward. It kept moving up. Let's see. Price kept moving up. So this entry would have still been just like our buy entry that I asked you guys to hold on gold currently. To still be active while we look to add more entries. So in this case here, price does not come back to trigger this second entry. We only get this first entry, and following the same process, following the same structures, the same process all through, looking for order flow legs created out of this higher time point of interest. So where if we had entered directly on the daily, we would have gotten 1:2 point something. Coming down to a lower time frame to look for price to create order flow legs out of this structure gives us a 1:5.14, right? So basically, that is how you use market structure, order flow, to actually pick out trades to take on the charts, on the price, when you are taking trades in any market. Right, so I will stop the video here because so it won't get too long. The next video I'm going to be uploading is on points of interest, PD arrays, the different PD arrays, how to use them, and how to apply them with order flow legs while you are trading. So do well to watch this video and ask me questions on the group chats, on the trade camp group chats, any questions you might have from the video.